Hello, my name's Charles Lastic. I am the Managing Director of Blue Bond Tax Planning. We've been inheritance tax planners for more than 18 years and have helped hundreds of clients save millions of pounds on their inheritance tax planning and implementation. So today's video is around what happens if your health is too poor to enable you to get a life insurance policy. Hi and welcome back. So today's video is around what happens if your health is too poor to enable you to get a life insurance policy, or it proves very, very expensive. Okay, so it's fairly obvious as people get older that their health deteriorates, but insurance companies appreciate that people's in their 70s health is going to be probably poorer than people in their 50s, and they take account for that in terms of the premiums. So when you're setting up a life insurance, provided you haven't got anything significant that could impact upon your lifespan, it shouldn't end up rating the policy by too much. However, for some people that is absolutely the case, and sometimes life insurance can end up being too expensive a methodology to avoid the inheritance tax. Well, okay. The bad news is, of course, you can't get the life insurance, you can't solve the problem immediately. And of course, if you've got poor health, does that mean actually you may not live 7 years, which is what it takes to pass assets out of your estate and have them completely free of inheritance tax? Well, there are other methodologies. For instance, if we encounter clients who are quite old, or they have significant health problems, then we don't think they're going to live the 7 years. In the end, if it's a married couple, as long as one person lives the 7 years, it's sort of fine. Then we would have to balance how the planning worked in any event. So sometimes if somebody's of ill health, and we wouldn't necessarily place investments into trust or anything like that, which would take 7 years for them, but we could do it for their spouse, right? Now, for almost everybody, you can buy assets which attract business relief, or what used to be known as business property relief. So although those assets can carry a high level of risk, with good due diligence, there are a number of plans that, okay, relatively speaking, you're still investing in one company, but if some companies, in the way that they work, they lend money to the NHS, for instance, as a possibility, right? They lend money to property developers, and they take the property developers already own the land, so they take out a plan which says, okay, we'll only lend you up to 2/3 the value of the land. Well, they always pretty much know they're going to get their money back, right? So some plans are of a lower risk nature, although all of them have to be regarded as of a high risk nature, because you are investing in one company. So sometimes the due diligence you need to look at, well, is there external oversight, for instance? Is somebody else double checking that this firm is doing what it's saying they're going to do, right? Because fraud can be an issue when we look at companies like Enron and things like that, which happened many years ago. So yeah, there are alternatives to life insurance policies. It does require an experienced advisor to deal with these kinds of things, especially if one gets into business relief plans, because there's a wide range of those, and getting the right ones to suit you is really important. So yeah, there are alternatives. It's not all lost, and it's not all doom and gloom. It can be avoided and it can be dealt with. You just need experienced help and advice. Okay, that's it. If you found that video useful, then please give us a thumbs up, and a like would appreciate it. It does help the channel, but thank you very much for listening, and goodbye for now. Bye.